Hey everyone, welcome to Turn My Coin YouTube channel. We help you make loads of serious money by educating you about Bitcoin and cryptocurrencies so you can make informed decisions before investing in cryptos. Both the cryptocurrency and financial markets depend on financial liquidity in some way. It is a process that quickly and effectively turns assets into cash while preventing sharp price fluctuations. However, if an asset is illiquid, it takes a long time to convert asset to cash. The higher the liquidity of an asset, better will be the trading, as the traders will not have to wait for orders to get through. Slippage is another possibility, or the difference between the price you wanted to sell an asset for and that price. Imagine waiting in a fast food restaurant to place your order. Having a lot of cashiers is like having liquidity. Orders and transactions could be completed more quickly, which would please customers. Illiquidity, on the other hand, is like having one cashier serving a long line of customers. Customers would become dissatisfied as a result of slower orders and transactions. Before we head forward, please like and subscribe to Turn My Coin channel to help us keep the content updated and provide you with more educational videos. The buyers and sellers of an asset in traditional finance provide liquidity. Decentralized finance, on the other hand, depends on liquidity pools to run. Without liquidity, a decentralized exchange, DEX, is similar to a plant without water. It won't last. DEXs are given a chance at survival by liquidity pools. A smart contract-locked digital hoard of cryptocurrencies is a liquidity pool. This generates liquidity to enable quicker transactions. A liquidity pool's automated market makers, AMMs, are a key component. Instead of using a traditional market of buyers and sellers, an AMM protocol uses liquidity pools to enable the automated trading of digital assets. In other words, users of an AMM platform contribute tokens to liquidity pools, and the AMM itself sets the price of the tokens in the pool. Additionally, blockchain-based online games and yield farming require liquidity pools. Users of various cryptocurrency platforms are encouraged to participate in liquidity pools, LPs, which are created for this purpose. Liquidity provider tokens, LPTs, are awarded to LPs after a predetermined period of time. These are a fraction of fees and incentives equal to the amount of liquidity they supply. On a DeFi network, LP tokens can be applied in various ways. Why are crypto liquidity pools important? Anyone with experience trading in the traditional or cryptocurrency markets can inform you of the possible drawbacks of entering a market with little liquidity. Slippage will be an issue when attempting to enter or exit any trade, whether it involves a low-cap cryptocurrency or a penny stock. Slippage is the discrepancy between a trade's anticipated price and the price at which it is actually executed. When a large order is executed but there isn't enough volume at the chosen price to maintain the bid-ask spread, slippage can also happen. Slippage is most common during times of higher volatility. The bid-ask spread of the order book for a particular trading pair determines the market order price utilized during times of high volatility. The same is with low activity in a typical order book model. This demonstrates that it is located in the middle of the range. This range is between the price at which sellers are willing to sell the item and the price at which buyers are willing to purchase it. However, inadequate liquidity can lead to more slippage and trading prices that are executed at prices significantly higher than those of the market orders, as shown by the bid-ask spread for the asset at any particular time. By offering incentives for users to provide cryptocurrency liquidity in exchange for a cut of trading commissions, liquidity pools seek to address the issue of illiquid markets. No buyer and seller matching are necessary when trading using liquidity pool protocols like Bancor or Uniswap. This implies that users can easily exchange their tokens and assets using liquidity provided by users and conducted through smart contracts without involving a mediator. Best liquidity pools in the market. The providers of cryptocurrency liquidity pools are crucial in addressing the order book model's problems with insufficient liquidity. Crypto exchanges won't rely on bidders and takers to fill the order book because of this. Let's note the best liquidity pools in the market. 1. Uniswap. Uniswap is a decentralized exchange for ERC20 tokens that supports 50% of Ethereum contracts and 50% of contracts for other target assets, ERC20 tokens. It enables a decentralized exchange of ETH for any other ERC20 token. 2. Curve Finance. Curve is a decentralized liquidity pool for stablecoin trading built on Ethereum. It provides users with low slippage because the stablecoin is not volatile, much like convexity. The platform lacks a native token, but a Curve token, CRV token, launch may exist. 3. Balancer. It is built on Ethereum and serves as a liquidity provider, non-custodial portfolio manager, and price sensor. Anyone can build or add liquidity to flexible pools and make money from trading commissions. Various pooling types, including private, shared, and smart pools, are supported by the composable balancer pooling protocol. Only the owner has full permission and can update parameters in a private pool. As opposed to private pools, all variables, including weights, tokens, fees, etc., are set in a shared pool permanently. 4. Bancor. An Ethereum-based blockchain protocol called Bancor makes use of pooled liquidity. It utilizes smart tokens, which are algorithmic market-making mechanisms, to ensure liquidity and accurate prices by maintaining a fixed ratio in relation to connected tokens, such as Curve, Uniswap, and others. G. And changing their supply. Bancor Relay refers to its liquidity pool. It introduces the Bancor stablecoin to address the liquidity volatility caused by the reliance on the native token, BNT. As a result, it permits the pooling of liquidity between the BNT token, Ethereum, or EOS tokens, and its stablecoin, USDB. 5. Kyber Network. Kyber is an on-chain liquidity protocol built on Ethereum that enables dApps to offer liquidity to improve user experience. Because of this, users are able to buy, sell, and receive different tokens from vendors and wallets all at once. Its native token, KNC, is used for ecosystem management and rewards. As a result, holders stake the token to participate in governance and receive the preset reward set forth by the smart contract. 6. Convexity Protocol. A decentralized liquidity pool provider is called Convexity. It creates an all-encompassing framework for tokens, which are fungible ERC-20 tokenized options contracts. Users can create collateralized options contracts and then sell those contracts for tokens. It has a small number of applications because it is a new idea. Liquidity insurance is one unique use case for the platform. As a result, it is safer for new traders or liquidity providers. Liquidity pools are required to conduct regular, unbiased, and quick trades. They serve as incentives to the investors who provide liquidity. Imagine buying your Ethereum and storing it for eternity. While one may like this type of long-term investing, others may want quick exchange and money by regularly buying and selling Ethereum. Imagine if there are no sellers of Ethereum and you want to buy it. How will the scenario work then? This is where liquidity pools helps investors. They provide liquidity to the market. They are great and innovative tools to earn rewards and have revolutionized the decentralized finance sector of the cryptocurrency industry. Hope you liked the video. Do drop in your questions and feedback in the comments below. For more educative videos on Bitcoin and cryptocurrency, subscribe to our channel Turn My Coin. Until next time, keep minting loads of money.